Has the equity market rally run its course? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Jem Karsan, founder of Kai Volatility. Hey there, how are you?
Hey, how are you? Good to be back.
I'm doing well, thanks. So we're still waiting on the final deal on the debt ceiling, but how are you thinking about the markets as we sort of work our way through this final stage?
Oh, wow, that's a big question. There's a lot of moving parts here. I think first and foremost, we'd be remiss if we didn't start with kind of the biggest story, which is kind of breadth, right, and the lack thereof. NVIDIA is the tip of the spear on that, and all the AI kind of excitement, um, exuberance, right? The reality is, I think very few people understand why breadth is important. It has a direct connection to volatility. Everybody thinks indexes are a constituent of its parts because that's what we've all been taught, right? And indexing itself takes the single stocks, adds them together, and it equals the index. But in today's day and age, the reality is that the index is just as powerful, if not more, than the parts, because that is where the majority of the directional trading takes place, and the hedging takes place. And the index vol is very well supplied and very compressed. And when that's the case, but you have fundamental pressures on liquidity, as we're seeing, as interest rates have gone to 5%, and we can get into the TGA kind of refilling and all the concerns there. But as that starts to happen, stocks that are not vol centers, that are not compressed, take on the liquidity of the primary source, which is the Fed and all the other primary liquidity, fundamental liquidity sources. And if those start to decrease, right? If those stocks start to decrease and the index vol is pinned, that means whatever is not pinned, which is the short vol center, has to go the other way to balance it. Just mathematically speaking, it has to happen. So the vol is very compressed. Indexes are pinned. We're at over 1 year lows, kind of in realized vol. Implied vol has followed suit. And guess what? 90. Only 10 stocks represent 97%, right, of the increase in the market. And so something has to, as all the other stocks are declining, something has to counterbalance that. And that is, not surprisingly, the short vol center, which is all those calls being bought in NVIDIA. 8 days ago, we had record levels of call buying in those names. That speculation is forcing dealer short vol in that complex. And this is a simple dispersion trade at its finest, right? And this is market microstructure at work. This is why breadth matters. It gives you, when the index is not moving, but the majority of the stocks start going down, that tells you something about the reality, the fundamental realities of liquidity versus what might be happening just structurally under the hood. And when you start to see divergences, not just like that, but in other parts of the market, that's a clue that this is a flows-based phenomenon and not a fundamental phenomenon. When those divergences happen, that's generally a very, very good clue to what might be coming.
Yeah.
So we'll start there.
Jem, yeah, do you think, and there's a lot in there, and I know a lot of people are listening to this and totally getting it. Some of our viewers may not, who don't sort of look under the hood like you do. So we'll try to pull it apart a little bit. Do you think that that this is the liquidity issues are kind of permanently driving now? Is this just sort of a moment in time, or has the sort of functioning now become more about that and less about what you called the fundamentals, which I presume are the kinds of things that we used to look at when we look at stocks?
It hasn't been about fundamentals for decades. Now, we can, again, that's the narrative you hear on CNBC, right?
Which is
and
why
that's
it's
what
really important that you
98%
say
of
that.
RIAs will tell their clients,
Yeah.
because the truth is too complicated for your average person to really look at or care about. It's not the narrative that is that most people have been told. I've given the analogy, I think, on here even, about the airplane, right? I'm not going to redo it, but the reality is that liquidity is what drives direction. Valuation is the elevation off the ground, right? And the reality is, you can be way off the ground, but if the liquidity is still firing, the plane will still continue to rise in a steady, solid fashion for years. A stock market is at the end of the day, factually, a matter of buyers and sellers, and it's a function of supply and demand. And liquidity goes straight to demand, right? And that is what matters. Supply and demand is what matters in the market. Fundamentals will matter at some point as a function, they will affect supply and demand, but how do they do that? Generally as a function of cash flow. They are a put on a business. And what do I mean by a put on the business? If there is no liquidity, at some point when liquidity gets removed from the system, all that ultimately matters is, can a stock itself provide the liquidity it needs to stay in business? And that's the context under which fundamentals matter, to the extent fundamentals affect demand for stocks. But we go often, not just years, but often a decade without, and we have gone at least that, more than that, since 2009 at least, where all that's mattered is not earnings, but liquidity. And when that's the case, stonks go up, to use a Wall Street bets phrase, right? Like that's the reality. It's all that matters is their demand. Now, that's starting to change, right? And when that happens, if the engines go off, if they start sputtering and there's no more gasoline in the tank, then guess what? The elevation off the ground does matter, right? And particularly on a stock by stock basis. Now this is when kind of value growth rotations and all kinds of things start to happen, because that put all of a sudden becomes a lot more important.
That's a great way to put it. Because I think that it's very different, as you say, when you listen to so many people who still talk about it in terms of those sort of earnings and their sales and their, like the types of things that used to really count. That's a really good way to look at it. So when this is happening now, how does that whole AI narrative fit in? Do you just think that's sort of like a red herring right now, or does it matter at the margin in the same way? Does that fit into that sort of fundamentals that matter, but they're not driving necessarily until you see things evaporate? Because everyone was like, AI is going to change our life. That's why Nvidia is going to new highs.
Look, the much bigger than Nvidia is the market and the S&P 500. And if the S&P 500 vol is pinned, and structurally you have a buying and selling force that is keeping realized vol temporarily, or for however long it may. 2017, it lasted a year and a half at bay, and fundamentally certain stocks are decaying based on the lack of liquidity for them, right? And the fundamental pressures that they're facing. That means for one or two or three stocks, it's a massive amount of counter. 490 of 500 stocks are going down or static. That means there has to be a pressure, right, on the other side. And that pressure, think about how much that is. 10 stocks, right, are getting are having to counterbalance 490. So that is a tremendous amount of buy pressure, and it is exacerbated by leverage, right, in a short vol center. This is what call squeezes kind of are about, right? This is a meme stock, or on the other side, we saw it with the bank stocks recently. But once gamma gets involved, there's a tremendous amount of leverage. Short gamma itself can be incredibly powerful, and when it has a tailwind in the force of structural flows to counterbalance what's happening in the other part of the market, it can be incredibly powerful. So my view is that yes, the call buying, the speculation in those names is driving, is loosening the liquidity and increasing leverage into a system that already has massive flows, and is trying to find a home to push certain assets in a certain direction, and that's like the weakest point, right? And so that's where we're seeing kind of this get going, and momentum begets more calls, begets more short gamma, and it's a self-fulfilling prophecy. The thing is, this doesn't go on forever, as we've already seen in several other parts of the market, as these same things have already played out in the last several years. Be careful shorting it, but also understand that when it ends, it's going to end violently, and it will be painful.
Yeah, that's exactly as you described that. I'm thinking to myself, and I think we're all thinking, this can never end well when there's that much pressure. So
we're at 35 times,
what
right?
happened?
35 times revenue, right? Listen, anything can keep going up as long as liquidity is there, and that's the point. But it is not, if we get to a point where the liquidity in the market is truly going out, right, the tide's going out, there is a point where the put matters. And at those valuations, there is no put within 90% of that valuation.
So what are you looking at in terms of liquidity then? If that's the key. And for those of you who are on the platform, you're going to see a thread here because this is what Raul's been talking about. I think we're going to tackle it on Friday. Michael Howell's been on it. This is what folks who are looking at the markets are really, really underscoring right now. So what are you looking at in terms of liquidity, Jim?
Well, I mean, look, the reality is, we talked about breadth, but just to give you some stats, we're at only 29, outperforming stocks are down to only 29% of the market. That's the lowest since 1999. That's a pretty big year to keep in mind, right? People talk about how crazy valuations were there on a discount rate relative to interest rates were more expensive than the recent peak by significant margin. And that's all kind of fundamental, but from a liquidity perspective, we've also increased interest rates from 0 to 5, right? And the lag of that is about 18 months. And guess where we are, right? About 18 months. And I think that's you can reference a lot of different people in terms of how those lags work. And I think we've referenced this before here, but it's really it's there's a $450 trillion global asset market, and about 380 trillion, of that 450 trillion is in lagging assets, real estate, private equity, venture capital, right? A lot of loans that really take a while, right, to catch up. And even the equity market itself is lagging in terms of supply and demand because of buybacks, which themselves operate on at least a 1 year, if not more. We had almost record buybacks in the first quarter. That's after an increase of 5% in the year prior. That's not because interest rates haven't hit the market, or aren't important. It's just because there's a lag in terms of the approval of buybacks and how they enter the market. So that's happening, and where the shorter acting liquidity pieces, which is kind of the Fed's balance sheet, the QE, QT part, has really not worked through the pipeline. And again, you can look at a lot of different liquidity models. People have been like, where's the QT? We've been talking about QT for a year and a half. What happened? And that's been counterbalanced by factors like the draining of the Treasury general account, right? It's a really big one. By most estimations, we're going to, by the end of the year, once the debt ceiling gets passed, we're going to have to issue $1.4 trillion in debt before the end of the year. That is a massive sucking sound out of asset markets, right? That money's got to go. There got to be buyers of that debt, which means that money's got to come from somewhere. And if that means interest rates go higher, right, as that demand, that supply comes on the market, and demand has to be met. That means equity markets or somewhere else, some other risk asset has to reduce liquidity. So, and that's a real-time effect, to be clear. That's supply and demand straight into the veins of the market, as opposed to interest rates, which is through the economy, much slower acting. And so you're going to get this very quick acting kind of reduction in liquidity, right as kind of the lag on kind of the other things is coming down the pipe at the same time. And so that's a pretty kind of bitches brew of liquidity issues all at once. I would pair with that liquidity issue, the fact that the last year and a half there's been a lot of short speculation, a lot of vol buying, and that led to a reduction in volatility, reduction in downside, and realized vol, as we've talked about in the last year and a half. But a lot of that has also dramatically changed because it didn't work. And a year and a half is a long time to be investing in vol on the long side and eating decay. And on the other side, it's a wonderful time, right, to be speculating short. And a lot of people have been, getting calls all the time now, like, well, hey, I bid 30, 40%, for the last year and a half just shorting these kind of puts. Why wouldn't I just keep doing that? So it's back. This is a cycle we go through. I could go through the history since 2015 of the sine curve of vol supply, and people crowd into shorting it, crowd into being long it, and it's dealer positioning at its core, and how these things move when things are working. Greed, is unavoidable. It's a feature of the system, not a bug. And so is fear, right? And I think we vacillate from one to another structurally because we have to, as money managers, as as entities trying to seek highest returns. And so where are we on that curve? And I'll quite frankly say that we reduced 30-day vol hedging by 40-50% as we move to zero DTE. That nobody's talking about how much real Vega hedging has reduced. Everybody's talking about the increase in zero DTE. Why? Because realized vol was working and implied wasn't, right? But then what happened? All the buyers originally buyers of zero DT have now turned sellers of zero DT, because guess what? That wasn't working either, because everybody crowded in there, which compressed realized vol. So now you have a broad phenomenon where it's broadly sellers across the board that's making dealers long, right? Which is forcing this kind of pinning. But what it is more and more creating is an unbalanced system where institutions are not hedged. Yes, dealers are hedging, but as soon as you break out of the general range, you can get to a really unbalanced, position in the market. So we're in a fundamental liquidity situation, which is dramatically deteriorating, while at the same time, the actual flows, are pinning the market and in the short term, but are structurally more and more unstable and more unhedged. So, kind of again, a particularly dangerous point in markets.
It certainly sounds like that. I mean, it sounds like you're really kind of setting up for the perfect conditions for a major event.
Yeah. I mean, the reality is, the more people know about this, I'm not the only one talking about these circumstances, right? The harder it is for it to transpire, but that doesn't mean it won't transpire. It just will transpire broadly. And this is what always happens as a function of time and price, that makes it very difficult to short it. And that's broadly what we're looking for. It's kind of what a topping process kind of looks like. Generally, you get a short squeeze, some overextension that is fairly violent or that unpins vol, or just a simple function of enough time where more and more vol speculation, more and more tail kind of unhedging kind of happens, where eventually you get a kind of 2018 type kind of forcing of over leverage in a system, and what the trajectory on is some function of time and price. We're looking for the stretching of a rubber band. Ideally, the more we get that, the more the opportunity is there. We would have liked to have seen a bit more squeezing of those shorts into this period. What's happening in NVIDIA is definitely welcome. So that's definitely creating an imbalance. And getting more and more people off sides and corners of the market. But generally this topping process necessitates a kind of some type of path, right? That will squeeze shorts, make it harder for long vol entities to be long. But the fundamental flows and the underlying flows are definitely heading quickly in that direction. And so it's just a matter of, in our opinion, when and how. It's going to take conviction. It always does. If it was easy, it would be, everybody would be shorting this all the time. But whether it's 2007, 2000, or even more recently, March 2020, it generally is very counterintuitive before it's intuitive, and that is a function of squeezing shorts and changing narrative and really shaking weak hands.
Yeah,
and I think that's what's necessary here in this final stage.
So I want to throw something else out as you describe this. So I mentioned that Raoul has been really focused on liquidity. So Raoul sat down with Jeff Snyder. I'm going to play another. It was an important conversation. We played a clip yesterday about inflation. I'm going to play another one for everyone today, talking about the sort of the sort of mismatch that they think that there is in the market. That just the market's telling them at least that something's not right. Let's have a listen to it.
Now, Eurodollar markets are pricing in what, a cut by July, isn't it?
Well, there's always probabilities, and I think the market right now is saying that we don't know about July. We don't know about June. June's kind of up in the air. July, you go back a couple weeks, the market was saying that there was a maybe 50-50 chance of a rate cut by July. That's kind of gone away now because of, ebbs and flows. What the market is saying is that September. By the time we get to September, rates are going to be lower, the short end as well as the long end. So that's really something happens this summer when we get to September, which only makes sense because you look at every crisis period or near every crisis period, it's always September. The middle of September, like the middle of March, that's a seasonal point which we always go through these things. So if you're thinking ahead, there's probably a really good chance that something happens in September, if not beforehand.
So that full interview is on our website. If you're not a member, scan the QR code and join our community. So Jim, it's interesting. We still have officials like even today, Cleveland Fed President Loretta Mester saying there's no compelling reason to pause U.S. rate hikes. And yet, as Jeff points out, they're looking at the global markets and the global markets are pricing in rate cuts. And so both sides can't be right. How are you thinking about this?
Yeah. A general risk-off positioning is partially what's responsible for the cap in rates, right? People have been flooding into the bond market, but the fundamental realities of inflation have not changed, and I think that's the important disconnect, right? The labor market's the strongest it's been at 3.4%, right? We're seeing historic onshoring, deglobalization. We're refilling reserves and the SPR, right, as OPEC's kind of underpinning oil prices. The dollar has been relatively weak. Long-term rates are down the back, which is also itself reflexively stimulative. Like all of these things, not to mention, markets have been hanging in really well in terms of a wealth effect. All of these things are structurally, inflationary. In the context of, the Fed was much more activist and hawkish, right, 3 months ago before all these things happened. The difference is we had a little bank run in between, and that's it. So structurally, nothing has changed, and by all accounts, that's again, we can argue whether it's going to be over or not, and we're going to force those shorts, but that is a tail in the market that is not core to the central realities of inflation. So yes, the market is completely out of step with the bond market, but I think that's more of a function of supply and demand, broad macro flows, and the Fed is going to, not just the Fed, the Treasury as well, as we talked about with the TGA, is going to force those rates higher. It's going to come to balance that. We've already seen it. I talked about this about a month ago on I think here, but also on a couple other platforms, how the market was dramatically underestimating the realities of June. At the time,
we did talk about that.
Yeah, at the time it was a 0%. Guess what? Now it's more than 50%, right? And the reality is that is likely to continue to go that way. I think the Fed is going to have to continue to push against that, and again, not just the Fed, but importantly the Treasury on a short term, much more kind of again right into the veins. As we talked about, reality is likely to have to force those higher just in terms of issuance. Again, just to put some numbers out there, $1.4 trillion in issuance before the end of 2003. By some accounts, $1 trillion of that will have to happen by the end of August. I mean, how does, this is in a world where the daily net liquidity, which sounds crazy, by the way, to some people, but the daily net liquidity that drives market direction is 50 to 75, this is for equity markets, 50 to 75 billion, right, per day. So $1 trillion is a tremendous thing to work against. And again, that should have reflexive effects on the market in short order. As soon as this, ironically, this debt ceiling is a kind of a sell the news event in that regard. And so something we need to be very, very thoughtful of. I do think there is a disconnect now because liquidity matters in the short term. But as soon as this reverses, I would expect the bond market to kind of meet the equity market where it is, and then the equity market itself to kind of reflexively respond to that liquidity as well.
So you don't think the Fed's going to be cutting? You think that bet is wrong in the bond market?
It is wrong. Yes, the only way they will is if the equity market has a dramatic decline. And can we get that dramatic decline? Absolutely. So one of the two, the two are going to converge, and my guess is that the bond market will force an increase in interest rates, right as the equity market will also have to decline somewhat to kind of meet somewhere in the middle. But
that bond market, those yields are going higher, not because people will listen to what you described before, where you have the lag effect hitting all those assets, that 18-month lag effect, and then you've got this liquidity, and that sounds like it's bad news for the stock market, but bad news for the economy. So then you would think that would take the pressure off the Fed, but you're saying that bond yields are not necessarily going to be looking at that. They've got to attract buyers. It's an issuance issue.
Correct. Everybody's still playing the last 40 years cyclical game, right? The whole game was very clear to the average watcher. It was the Fed was in control of a system. We had not had inflation for 40 years. It was structurally deflationary environment. And anytime we got a cyclically deflation, all the Fed had to do was come in and cut rates and stimulate liquidity, and we would simply push back up. That's all fine and well, but why can't the Fed continue to do that? Well, they have a dual mandate: price stability and maximum employment. When we're in a deflationary environment, they can cyclically stimulate all day long and push against that deflationary pressure. But that has changed, and we could do another 3 hours on why that is. I've talked about that ad nauseum. But the reality is there's structurally inflationary pressures that we've seen, again, historically in other environments for the same reasons. At the end of the day, it's about balancing inequality and populism. But there's other generational factors which tie it to this moment. But the reality is that we are in a structurally deflationary environment until we decide as a people, not just as a government, but as a people, to not make those things a priority. Then those structural inflationary forces will continue, and that puts the Fed in a box. That means the Fed has lost control. We are no longer in a two-dimensional system where the Fed can just come simply pressure against the decline in employment and balance deflation. But now, if they come back into the fray and stimulate cyclically, they will exacerbate, much like they did in the early 70s, structural inflation. And that structural inflation could be much worse than we've seen so far, and likely will be if they do that. And that is what stagflation is all about, and something that nobody's experienced for 40 years, and all the algos that are looking at 40 years of history also haven't experienced. It is an added dimensionality to the system, and is much more dangerous, as well, not just for equity markets, but broadly for liquidity across the market when the Fed loses control.
And one of the things I love about the way you're describing this, Jem, is that it is multidimensional. Like, we can see this. There are all these forces at work, sometimes together, sometimes counterbalancing. And I think that you really laid it out in a way that helps us understand that. By the way, Christopher is saying very impressive whiteboard behind you. So we know they're very observant, our crew. So we have some great questions. I'm going to try to squeeze a couple in, but I just wanted to ask you, since we're on this. So I know you just came from a conference. I know people are talking about a liquidity event. They are, but most of them are focused on the short term around the general account. You're also describing these longer lag effects coming in. People are talking about vol events. Do you see this liquidity event continuing through the second half of the year? Is this a more temporary situation, and then we're going to see liquidity? I think that people who think it's going to come from the Fed and QE or lower rates. But if you think that bet's wrong, then do you see this lack of liquidity continuing into the second half?
So let's go back to end of December 2019. I was on the phone regularly with my biggest institutional client at the time about COVID. This is end of December 2019. It was a known entity. It took a rally throughout end of December, early January, midway through February, right? For a 30% decline in markets to begin. The realities of COVID were always there. The fundamental liquidity concerns were always there. I think that's a microcosm of just how markets work. People knew about it. They were trying to short the market. They were trying to buy hedges. And broadly, it took a situation where the liquidity was poor for there to be a crack, right? There for things to break. And that crack was S&P March quarterly structured products and hedges were much more short for dealers there than they were in February and January. And that's why the decline started the day after February options expiration and ended the day after March OPEX, right? It's not a coincidence. It's why, correlation went to actually 1.1, right? And the center of the S&P itself was actually the worst hit, because that was the vol center where the problems were the biggest. But the liquidity had to get to a point where the market could break it. It had to shake the weak hands. And that can happen as a function of price. So that's why we get a lot of blow off tops. That's why it often is kind of a fast move that ends it. Or it can happen just as a function of building pressure in terms of short vol or other structured risk in the market. And that's generally a function of time. And that's what I've talked about before. But the path to this decline, which is a structural problem, right, is a shaking of liquidity. And if you're asking me to time that exactly, it's hard. But in the back half of the year, it should happen. I would say that the more counter-trend liquidity, the more of a squeeze we get, the sooner it will happen. So it's kind of like stretching a rubber band. We would have liked to have seen that already. But also, the more talking heads like me come on and educate people about this, also reflexively, the longer it can take. And that's why markets often, can stay irrational longer than people can stay solvent. I think that's an important point.
Yeah, it's always worth remembering that. And this is invisible to a lot of people who are watching the markets. And that's what's so dangerous and worries us a lot of the time, that people are not aware of these other dynamics. They see it through a different lens. And that can be really dangerous when it comes to protecting your money. One quick question we're going to squeeze in. Do you have an opinion on how the Fed and Treasury will react to the lack of liquidity? Is this something they're going to take into consideration?
They will when they have to. I do not think they will be proactive about it. Partially because I actually think the Fed wants a little air out of this market. They've been trying to write calls. They've been trying to talk, rates higher on the long end of the curve. They've been trying to, remove the wealth effect so they can, stop raising rates ultimately themselves. So ironically, don't fight the Fed, right? The markets have been fighting the Fed, as you alluded to, as we're all, and Snyder were talking about, right? They want things to be more in line. And so, how does that happen? Well, they let this thing breathe a little bit and they let rates go higher as supply of treasuries comes on the market.
And then a question about thoughts on June OPEX.
So these big OPEXs matter. It's not a coincidence that mid-August into mid-September is often a scary time. It's not a coincidence that mid-February into mid-March, as we saw with the COVID crash, is often a scary time. June, there's a reason sell in May and go away exists. Again, June sits right there. December is a little bit of a different animal because it's end of the year. It's the most holidays of the year. There's several other dynamics that counteract some of that risk there. But these other three quarterly OPEX are very important to timing. It doesn't mean a crash necessarily happens there, but what that means is you have a fatter tail in those windows. And so now the reality is, if expected return is the same and you have a fatter tail, that means this distribution needs to be a little bit more right distributed. And that also tends to be the case. And this is the dynamic of buyback, this Von and Charm effect I talk about. As a tail that's fat decays, right? The hedgers, the dealers who are short those puts, that are short that gamma, ultimately have to buy back that stock. And that creates a linear buyback that can reduce volatility, create a positive force. But that doesn't mean the fat tail doesn't exist. And I think thinking about this more distributionally is very important. Everybody wants to know up, down. Are we going up? Or are we going down? When are we going down? When are we going up? The reality is you need to be very much more cognizant of what the potential risk and distribution of potential returns looks like in given windows and trade according to that. You can do that with options more broadly, but also manage risk accordingly, with stops and other types of trades.
Well, we just got a masterclass in some of this from you, Jem, and it's so important to have this conversation as we head into these, what sounds like it's going to be pretty turbulent water. So we appreciate you making it, or talking about it in a way that the rest of us can understand. It's not easy.
Always a pleasure.
Thank you so much. Thanks for the great questions, everyone. If you thought you were going to be able to think to just sort of put your stuff in and take a few months off, it sounds like you're not. So we're going to all have to be very vigilant, and we'll have Jem back on again to help us do that. Thanks to all of you. Thanks for the great questions. As always, take care and good luck out there.